Welcome to today's lesson focusing on indicators. Many of you have been thinking about indicators or have been waiting for that topic. Some food for thought before we begin. Do not put too much weight on indicators. They're a great way for beginners to identify trends, but they're certainly not the only thing in your way to success. Outline. Little disclaimer, moving averages, the EMA, RSIs, fib retracements, MACDs, and volume. Little disclaimer, be careful when trading with actual live funds. Trading is highly risky. The moving average. So moving average is a simple technical analysis tool that is usually calculated to identify trend direction of an asset or to determine its support and resistance levels. It is a trend following or lagging tool. Most indicators are lagging indicators. They're lagging behind the actual trend. When it comes to the moving average, the longer the moving average, the greater the lag. Moving averages actually represent the average price of an asset for a certain number of candles. For example, you've got a 20-day moving average. So it's the average price, the median price of the asset during the last 20 days. And we're going to look at a couple of examples on the live chart in a second. For different time frames, we will also use different values of the moving average. On the daily chart, we'll look at a 20-period moving average, while on other time frames, such as 1 hour, the 20-period moving average will be a lot different. Let's look at some examples on TradingView, shall we? All right, folks, we're back in the chart, and we're currently looking at a daily chart of gold. How do we actually add an indicator? Well, in TradingView, we'll simply click on our Indicators tab, and we're going to search for moving average. Once we clicked on that, the moving average will be added to our chart. Please note that it currently is added with a 9-period moving average, so it shows us the price of the last 9 days. We want to change that. We want to put it at least to a 20-period moving average. We go into the settings, adapt the length, and then confirm with OK. What we're seeing here right now is a 20-period moving average. Price at one point trading above, below, above, and below again. Price is ranging here. It's trending below the moving average. It's trending above the moving average. So in other words, if it's trading above, we're clearly in an uptrending market structure. If it's trading below, we're in a downtrending market structure. If it's trading continuously up and down, we're clearly in a ranging market. Why are these indicators lagging behind? In this example here, just focus on the circle. We can clearly see that the price is trading below the moving average. Then price reverses and the uptrend actually starts down here. But the moving average doesn't take that into consideration. It's lagging behind a couple of days until it finally picks up momentum and shows us the uptrending market. The same goes for this area here. The price starts to go down, but we're still above the moving average. Prices move up, start to go down. The trend starts here, the downtrend, and we're still above the moving average. A small uptrend starts down here, but we're still way below the moving average. This here is the moving average on a different time frame. As you can see, the longer it is, the more it lags behind. This here is a very fast moving market. We're on a 1 hour chart and we can see price trading above, below pretty much all the time. So is there a workaround to that? Well, let's go and have a look. We'll go into the settings and adapt our moving average to 100 period moving average to take the last 100 candles into consideration, giving us maybe a slight advantage in understanding where price might head next. Okay, so we are seeing what we've been seeing on a daily chart, that price is currently in a range. We're trading below the moving average, above and below. When I'm making the chart smaller, we can see the moving average acts like a magnet within a tool. So if you are in a clearly identified trend, the moving average pretty much acts as your resistance. Let's try and change that to a 200 period moving average now. Notice any changes? Well, it's a little bit more smooth. Like here we can clearly see prices trading way below the moving average, and the moving average in the downtrend is acting as resistance. And here we can clearly see the moving average showing us a sideways market. We're trading above and below pretty much all the time. Relative Strength Index. Let's move on to the RSI. The RSI is a momentum indicator used in technical analysis that measures the magnitude of a recent price change to evaluate either overbought or oversold conditions in the price of an asset. So the RSI is displayed on an oscillator. So it's an oscillating, moving graph, and can have a reading from 0 to 100. We're going to see some examples on how that actually looks like. In the traditional markets, traders are using the RSI to identify overbought conditions above 70 or oversold, overvalued conditions, undervalued conditions actually below 30. As for a couple of examples, we're going to jump into TradingView and look at that right now. All right, folks, we're back in TradingView on a daily chart, and let's go and add an RSI. Back here to indicators, we're looking for Relative Strength Index, and we can also mark indicators with favorites. So I'm going to add this here, close this window, and we can see our RSI indicator below here. Now, what is the RSI showing me? We've got lines here between 100, a reading between 100 and 0, and the price oscillating between the upside and the downside. Let's transpose what we see down here up to the actual chart. If I'm zooming in here, we can see the oscillator pretty much fluctuating all the time. It's going below oversold conditions and overbought conditions. How you can use that to your advantage. Let's put it back on the chart and let's see what it actually means. The price starts to move down and the RSI is moving close to below 30, which is usually a good indicator that we are in oversold territory. The price starts to consolidate to range, and so does the RSI. In this example here, the price is moving to the upside and the RSI shoots above 70, which indicates overbought conditions. Like it's exhausted, it's been up there for too long, there are not a lot of people that want to pay such a high price anymore. What happens? The prices are falling and the RSI goes down. Please proceed with caution, as the RSI, like many other indicators, is a lagging indicator. The down move might start faster than you can actually see it on a graph. Let's transpose what we see here to a 1 hour chart. Oftentimes, people are using these signals in oversold territory below 30 as buy signals. Please proceed with caution. It doesn't mean necessarily that price will immediately bounce up. In this example here, we see price in a downtrend. We're creating a pivotal point here, okay? And the RSI is indicating oversold below 30, which people are using to their advantage as a buy signal. Now the RSI comes back into the range, goes up, and then immediately goes much lower, showing a convergence in price. So we're going slightly below 30, still being above this low, and then price finally reverses. So please be careful on how fast you are reacting to any indicator. They're not set in stone and they're lagging behind. Remember, the RSI is only one item on your checklist. Do not only use an RSI to make an informed decision. Try to focus on support and resistance, the RSI, a moving average, different concepts converging in one area. That's the most important message here. Please keep that in mind. Do not rely only on one indicator. Try to get different concepts together, market structure, price action in general, and make an informed decision. The RSI is here to help you, to enhance what you already know. But it's not the only thing that is going to make you successful. We are going to cover this in further detail in our trading strategies. When is a good time to get in? When is a good time to use an RSI? So bear with us. We're going into this in more depth a little bit later on. Fibonacci retracements. They are levels helping us understand retracements. Horizontal lines that indicate where support and resistance are likely to occur. The indicator is useful because it can be drawn after an impulse move between two significant price points. We're going to see a couple of examples of that. So the Fib retracement levels are 23.6, 38.2, 61.8, 78.6, while not officially a Fibonacci ratio, 50 is also used because a 50% retracement is a commonly used concept amongst traders measuring a swing. Everything that goes up must come down. In this scenario here, price is heavily moving to the upside and it's exhausted, so it needs to come back down to find a bunch of new buyers, people that are willing to pay higher prices than down here. Let's jump into TradingView and see how we can set that up. Back to the charts. We're looking at gold on a 4-hour chart, and we are going to add a Fib extension to see levels of retracement. We've clearly identified that we have a high swing point here, and price has just created a low swing point here with some sign of reversal. We don't know yet. So let's use our Fib tool. You will find the Fib tool in your drawing tools by opening the menu here, and it says Fib retracement. So click on that, point it to the high of the swing here, and drag it all the way down to the wick of this lowest candle. What we can see here is that price goes from 1 to 0, or a 100 level to a 0 level, with a 50% being here in the middle. We can now go into the settings and extend the lines to the right to predict a future outcome. Now, in such a heavy downward movement market, it is desirable if the price can at least retrace 50% of this move. Now, in order to see if that is something in our back testing that we can use to our advantage, we simply use the replay tool, go back in time. By the way, we're going to focus a lot on back testing into replay tool very soon, and we can actually play and see how that would have worked out. All right, so now that we've got a lot of more candles, we can see that price has already retraced to about 50% and more of the recent downtrend. As it does so, we can also see swing points that are being broken. So you've got a high here, you've got new lows being formed and highs. So it's an uptrend, higher highs and higher lows. We're now looking at another example of gold on a daily chart, and we are measuring this lowest point down here, this swing low, all the way to the swing high. What we're expecting is for price to at least retrace 50%, which it does, and then bounce a little bit higher. Yeah? But you can see that those levels on our Fib retracement are met almost accurately. So we've got a little support in here before prices go up, and we've got resistance up here before prices are going lower. So it's a very powerful tool in trying to predict levels of retracement with the highest accuracy possible. So like the RSI and the moving average, the Fibonacci retracement is an additional tool in your arsenal of weapons, making it in this market. Now on to the MACD. The moving average convergence divergence MACD is a trend following momentum indicator that shows the relationship between two moving averages. So not only one, but two. So the MACD is being calculated by using or subtracting the 26-period exponential moving average, the EMA, from a 12-period EMA. So the MACD triggers a technical signal when it crosses above to buy or below to sell the signal line. The MACD helps understand whether the bullish or bearish movement or structure in the price is strengthening or weakening. And we're going to look at a couple of examples now on TradingView. Remember, it's not the only indicator out there. It's an additional tool that helps you understand or make an informed decision. We're back on the chart, folks, looking at the MACD. How do you actually add the MACD? Click on your indicators, look for MACD, moving average, convergence, divergence. We add it to our chart, and we're looking at a daily chart of an asset, and we're focusing on divergence in the market. Reversal signals that could indicate the market turning around into the other direction. Please note that we are not personally using the MACD a lot. It's not an indicator that we're focused on, but we're illustrating this to display on how it is being used and why people think it helps them in their daily trading. So let's look at it right now. The first thing we're doing is we're looking at an example of bearish divergence. So we can see the histogram here on the MACD and this highest candle form. Prices are moving back up, moving up and creating a higher high. Now, between the peaks of the histogram, we can see that it's pointing to the upside here and to the downside here, which indicates that prices are likely to reverse. Okay, and so on a higher time frame, let's zoom out a little bit here, we can see that prices are starting to fall lower. Now, to summarize the MACD again, we're looking at the value of moving averages. So we've got a fast moving average, a 12 period, and we've got a longer one, a 26 period. The histogram on the MACD shows the value between subtracting the 26 from the 12. Yeah? People are using that as a trend reversal indicator, but keep in mind, we're not using that many indicators in our daily trading activities. Yeah? And like many other indicators, the MACD is a lagging indicator. It will not show you accurate data, only after the fact. So right now there is something interesting happening here. So we've got one moving average that is crossing to the downside. Yeah? The histogram is showing some signs of red.
And a lot of people would take that as an entry signal. So please be aware that it's a lagging indicator, and it doesn't guarantee you any kind of profit for sure. So with that being said, let's move on to the next topic.
On to the volume. Trading volume is highly important and used by most of the professional traders out there. Trading volume is a measure of how much a given fund, like an asset, has traded in a period of time. For a stock, volume is measured in the number of shares traded. So for example, if you're looking at Nike, Amazon, or Tesla, the volume indicator shows you of how many shares have actually been transacted during a period of time. For futures, options, CFDs, the volume is based on the contracts, like how many contracts are being bought and sold. So the traders are looking to volume to determine liquidity and combine changes in volume with technical indicators to make trading decisions. So it's another tool in your checklist to use when making a decision, when making an entry in the market. And the volume plays an important role in technical analysis for some strategies, most strategies. Example, for breakout strategy, we are using the volume readings to confirm that increasing volume will increase the chances to break out some key levels, that a trend might start or come to an end. And let's look at a couple of examples right now. Back to the charts, we're looking at volume. Indicators, just simply search for volume and you will have the volume indicator here. Tap on it and it will add the volume bars to your chart. Now, how can he help us? We're currently looking at a 1 hour chart of gold and we've identified an area of resistance. We're in a downward market and a couple of times price tried to break out above these levels, then consolidated for a little bit here, and then volume came into the market higher than average volume if you look to the left, and it broke out to the upside, which indicated this move has come to an end and we might be in for an upside. One more point that is very important here. Most traders are not using a lot of indicators that they're putting on their charts. They simply know from experience on what might happen next. Concepts here. We've created a swing low here and we've moved above resistance with one big candle on volume. We've retraced 50%. So if we were to put our Fibonacci retracement tool here on the chart, we know that we've retraced 50% of the move. On the other hand as well, if we were to put on an RSI indicator, it would show us on a lower time frame that we're oversold here, or overbought actually, before we're moving down to retrace. That pretty much concludes our session for today. So remember guys, indicators are mostly lagging behind. Do not put too much emphasis on indicators only. Use them as part of your checklist in navigating the markets. Try and understand different concepts that are converging in one area. And that will make you successful in the long run. And remember, we're going to look at backtesting and how you can see if all of this would have worked out in the past to train for the future. See you guys on the next one.